How bad is the housing situation in Sydney and Melbourne? What is the future entailing for these markets and what should people do in this situation? We're going to examine now in depth the current state, the demand and supply of these markets, and at the end we will go through data which shows whether housing is over or undervalued. As always, everything said is for educational purposes only and should not be considered to be financial advice. Let's begin with an overview of Sydney. The Sydney property market is going through a lot of turbulence over a historic period of growth during 2021 when median home values rose by 25.3%. The Sydney prices are now correcting at a pace not seen in close to 40 years according to data stemming from CoreLogic, one of the main housing analytical firms. Although there is hope that the market is close to a bottom as declines eased in September in comparison with August, in August home values fell by 1.6% and now in September a drop of -1.4% was recorded. At the end of the day, the main focus for predicting the housing market should be on what the RBA does with its main interest rate. As the research director at CoreLogic, Tim Wallace, says, it's possible we have seen an initial shock of rapid rise in interest rates pass through the market and most borrowers and prospective home buyers have now priced in further rate hikes. However, if rates continue to rise rapidly like in May of 2022, we could see a further decline in home values. Overall, the whole of Australia property prices are down by -5.5% on average from their peaks for each capital city. On the next chart taken from PropTrack, we can see the annual home price index growth from 2015 until today for each main city. What we see is that currently only Sydney and Melbourne are experiencing annual price declines of -2 and -4%. Let's now examine Sydney from a closer look. Compared to 12 months ago, not long after the peak of the property boom, new listings are up +4.3% in Sydney, while total listings on the market are up by 31.3%, so supply has increased considerably. A drop in demand can also be seen in sales figures. The volume of sales in the last 12 months to August of 2022 is down by -14.6% compared to the previous 12-month period. As a result, Sydney's median days on market, or DOM, is currently at 37 for the quarter, up from 25 in August of 2021. Let's now discuss the best Sydney suburbs according to data from OpenAgent. Randwick, Narrabeen, Drummoyne, Neutral Bay and Surrey Hills. All of these suburbs have an average above a 1.2 million median price. Only Surrey Hills stands at a little below 1 million. On the other hand, the most affordable suburbs in Sydney are Carramar with a median price of 345,000. Then comes Fairfield at 430,000. The third most affordable suburb is Campsie with a median price of 627,000. Then comes Bidwell with a price of 668,000, and the fifth most affordable suburb is Engadine with a price tag of 720,000. When we examine Melbourne, the data is similar. Melton is the cheapest suburb in Melbourne with a price tag of about 410,000. Large blocks and new modern houses make Rockbank, Diggers Rest and Caroline Springs all attractive to first-time home buyers and families. Closer to the city, cheaper options include Truganina, Tarnate and Laverton. Laverton is just 17 kilometers from the center and a 30-minute journey by train. According to CoreLogic, Crib Point, Knoxfield, Mordialloc, Ashwood and Mornington have had the highest one-year growths, while Ashwood, Crib Point, Knoxville, Scoresby and Templestowe have had the highest 10-year average growths. All of these suburbs have a median listing price of above 1 million. Now we'll examine the supply and demand of the market in relation to the population growth of both Sydney and Melbourne. As of June, according to the Australian Bureau of Statistics, Melbourne has a population size of around 5.7 million. At the same time, the number of dwellings is 2.06 million. When we divide the two, we come up with a 2.76 people per dwelling. The average growth rate of Melbourne's population is 3.62% per year over the last 10 years, while the expected new dwellings that should be built over the next 5 years is between 140,000 and 150,000. So let's make quick and easy calculations. A 3.62% increase in the population size would equal around 206,000 new residents per year. If we take the current number of people per dwelling of 2.76 and we divide this by 206,000, we get an average demand for new housing of around 74,000 dwellings per year. We multiply this by 5 years and we get a total demand for new dwellings in the next 5 years of 373,000. This is more than 2 times higher than what is expected to be built over the next 5 years in Melbourne. From this aspect, a lot of pressure could be placed on Melbourne homes, and their price increases can have strong fundamentals behind them coming from the population growth. Let's now check up Sydney's dynamics. As of June 2022, the population of Sydney is 6.4 million, while the number of total dwellings is 2.08 million. When we divide the two, we get an average of 3.07 people per dwelling. The average population growth over the last 10 years for Sydney is 4.47%. At the same time, the upcoming new dwellings supply over the coming 5 years would be between 143,000 and 160,000 dwellings. If the population growth stays on track, this would mean that over the next 5 years, the population would rise by about 286,000 per year. If we divide now 286,000 by 307, we get 93,000 new dwellings per year that are going to be needed, which over a 5-year period is 465,000 total dwellings needed over a 5-year period. This is even a bigger discrepancy when compared to Melbourne, and it tells us that Sydney most likely will have a higher shortage of housing over the next half a decade. So from supply and demand fundamentals, the price of both Sydney and Melbourne could be going higher over the next 5-year period. Another fundamental factor which supports the rise in prices is the high inflation in Australia, which can be seen on the next chart. The current high inflation levels are the highest in 20 years, and this devaluation of the Australian dollar makes it so that we need more Aussie dollars to buy the same stuff, and in this case, real estate. The opinion of some of the investing greats like Paul Tudor Jones, Ray Dalio, Nouriel Roubini, and others is that we're entering a period of stagflation. If truly this is coming, we need to look back at history and see which assets are performing well, so that we can potentially not only protect our savings but also profit. On the next chart provided, we can see the best performers during the last stagflation period during the 70s. The best ones are the energy equities and real estate. Be sure to check out our energy analysis videos on our channel, as this asset class is the best performing according to history. Real estate is a natural performer due to the fact that it is a real hard asset which pays cash flows stemming from the rental income. These types of assets are the best in an inflationary or stagflationary scenarios. If we examine the last 1 year of real estate around the world, we'll see it is performing quite well, and at the same time the bond, stock and crypto markets around the world are suffering. For example, the Australian stock market over the last 1 year has fallen by 10%, but this is the nominal return. To find out what our real return is, we must add on to this the inflation level, which currently in Australia is 6.1%. which means that on real adjusted basis we have lost 16.1%. For the same one-year period, the US stock market has fallen by 22%, and with an inflation rate of 8.5% in the US, our real US dollar-denominated return is minus 30.5% over the last 1 year. At the same time, from September 2021 until September of 2022, the national average home price appreciation in Australia is 2.5% according to data from PropTrack. But again, this is a nominal return. From this 2.5%, we must take out the inflation level of 6.1%, and then we get a real return of minus 3.6%, which is multiple times better when compared to the US and Aussie stock markets. The bond market has even worse returns than that. The crypto market, on the other hand, has fallen by about 70% on a nominal basis. To find out the real return on top of the 70%, we must add on the inflation. Even though Aussie real estate does not give us a positive real return over the last 1 year, it is one of the best performing asset classes alongside the potentially prolonged inflation in the coming 5 years and the lack of supply. This gives a high probability that homes in Sydney and Melbourne will continue to rise. Be sure to check out our other videos about the Aussie housing and stock markets and subscribe to our channel so you gain an investing edge. Hit the notification bell to make sure you don't miss out any of our latest videos, and I'll see you in the next one.